All right, welcome to today's headline roundup. Thanksgiving week. How about that, Dennis? We're wrapping up the year quickly, but thank you all for joining us today. If you have questions during the presentation, go ahead and type those into the questions box. We'll get them answered as soon as we can. But without further ado, we're a couple minutes behind. So Dennis, you ready to roll?
Yeah, lots of slides here too today, Mark. So I'll jump right in. And again, if you have a question, there is a questions box on the right-hand side of the screen. I want to talk to you this week. Freight demand continues to decline. There were some signs this week. Fed President Bostic from the Atlanta Federal Reserve Bank indicated that rate increases may be slowing or stopping. Biden, now that the election over, is now warning of economic setbacks, and Americans are coping with inflation by taking on debt. Home sales continue to decline, and I want to give you a retail sales update here as we enter the shopping season. So a lot to talk about, starting with freight demand. This is from Zach Strickland. Maritime, rail, and trucking demand is still falling as we move into historically slow months. Container imports, rail intermodal shipments, and truckload demand have fallen from their lofty peaks during the pandemic era, and maybe a better indication of how inflation will be tamed in the coming months. Certainly, that would be true if we were in a supply-driven inflationary environment. I believe that what we're really seeing is inflation as a result of economic and monetary policy, to be specific. The outbound tender volume index, which measures truckload capacity, is now only 9% higher than it was the week before Thanksgiving in 2019. Demand destruction has occurred at a much more significant level than suggested by the dollar figures that drive a lot of macroeconomic data. And the Fed's Bostic, you see him in the picture, he is the president of the Atlanta Federal Reserve Bank. Bostic indicated this past week that he's ready to move away from large rate increases. Raphael Bostic said Saturday, and incidentally, I brought up Mr. Bostic in the last couple months here on the Headline Roundup webinar. Mr. Bostic did not report some trades that he made, which he profited from. So he was in the news for a not very flattering story here in the last couple months. This past Saturday, he has said he's ready to move away from the 3/4 point rate hikes at the Fed's December meeting, and he feels the Fed's target policy rate need raise no more than another percentage point to tackle inflation. Federal Reserve President of the San Francisco Bank, Mary Daly, made similar comments that I brought up within the last couple of weeks here. Bostic says if the economy proceeds as I expect, and I should note that the Fed has one of the worst forecasting track records when it comes to what will happen to economic activity. But Bostic says 75 to 100 basis points, which means 0.75% to 1% in additional increases may be warranted. But he says at that point, I think that'll be sufficient. I think that will be enough. That would put the Fed rate at between 4.75 and 5%. It's currently between 3.75 and 4%. The Fed is widely expected once again at its December meeting to raise rates. As this article points out, the consensus among forecasters is a 0.5 percentage point, but we'll have to wait and see. Bostic says that given the inflation surprises of the past year, I think it's interesting that he used the term inflation surprises. It really wasn't a surprise to those of us that have been forecasting it, given that the Fed created $5 trillion in new currency out of thin air from March of 2020 to earlier this year. He said at some point the Fed will need to pause and let the economic dynamics play out, given that it may take what he estimates as anywhere from between 12 and 24 months for the impact of Fed rate increases to be fully realized. Certainly, I think that there is a lag between interest rates declining and currency creation and the resulting inflation. So as we go the other way, I think that that is true as well. I do not expect the Fed to get this right, and I do expect them not to get inflation under control, and I do expect that they will pivot. Bostic says being more cautious as policy moves deeper into restrictive territory seems prudent. He said even if we have to raise rates again later. He said the Fed should guard against any temptation to cut rates before inflation is well on track to fall to the Fed's 2% target. You'll notice he chose his words carefully there. He said the inflation needs to be well on track to fall. He doesn't say that inflation needs to be back at the Fed's 2% target. Joe Biden now, post-election, warns of upcoming setbacks in the economy. I think that is a given. Biden said this, quote, "It's going to take time to get inflation back to normal levels as we keep our job market strong, so we could see setbacks along the way." He promised the White House would remain laser focused on the economy. He claimed that inflation at the grocery store was down slightly, even though the cost of food at home is up over 12% year over year. These comments were made by Biden as he was meeting with a group of business and labor leaders. He argued during that meeting that economic growth is up 2.6% and unemployment numbers are still low. And he pointed to those numbers, stating that his policies are working. It's important to point out that economic data is reported using US dollars that have been massively devalued over the past couple of years. That skews the reported data to the positive side. And the economic growth numbers that Biden is quoting is before third quarter numbers have been revised, which I do expect will happen as well. Biden told Americans to be patient, and he pointed out that there will be cheaper medicine for diabetes, and he also suggested that the tax credits for replacing heating systems and mounting solar panels will be an economic boost. The reality is the middle class and the lower income households in the U.S. Need to have the cash to be able to install those systems. And as you'll see from one of the stories I'm going to cover in just a minute, that is not the case. Household debt soars at the fastest pace in 15 years as credit card use surges. This is according to a Fed report. This is reported by Jeff Cox of CNBC. Mr. Cox writes this: households increased debt during the third quarter at the fastest pace in 15 years due to hefty increases in credit card usage and mortgage balances. Total debt jumped by $351 billion for the July to September period. That's the largest nominal quarterly increase since 2007. That brings the collective household IOU in the U.S. to a fresh record of $16.5 trillion. That's half of GDP. That's an increase of 2.2% from the prior quarter and a whopping 8.3% from a year ago. The increase follows a $310 billion jump in the second quarter and represents a $1.27 trillion annual increase. That's a mind-boggling number. American households now have $1.27 trillion more in debt than they had just 1 year ago. Cox, I believe, correctly points out that debt has surged over the past year because inflation is consuming a lot of discretionary income, and a lot of consumers are adding debt to cope with inflation. The biggest contributors to that debt load came from mortgage balances. Mortgage balances were up $1 trillion from a year ago. Credit card debt is also approaching $1 trillion, up more than 15% from the same period in 2021. That's the largest annual jump in credit card debt in more than 20 years. That's according to the New York Federal Reserve. The increased quote towers over the last 18 years of data, and that's according to a group of Fed researchers that posted this information in a blog post on the central bank site. Dong-Hoon Lee, who is an economic research advisor at the New York Fed, said this, quote, credit card, mortgage, and auto loan balances continued to increase in the third quarter of 2022, reflecting a combination of robust consumer demand and higher prices. I believe that it represents higher prices, and given that the credit card debt number is up more than it's been in 18 years, I think that alone is a testament to how many consumers are dealing with a higher inflation. Mortgage originations have slowed to pre-pandemic levels as interest rates have gone up. Interest rates on a 30-year mortgage are now north of 7%, which gets them back to what I would consider to be a normal range. Now, along with the rise in balances, it's no surprise that there are more delinquencies as well. While delinquency rates are rising, they remain low by historical standards and suggest consumers are managing their finances through the period of increasing prices. I would not necessarily draw that conclusion. Auto loan balances, 1.52 trillion. Student loan debt now dropped to just under $1.6 trillion, which is the lowest it's been since the second quarter of 2021. That is because of loan forgiveness programs at this point. Auto loan debt is up 5.6% from a year ago. Mortgage balances are higher, 30-year mortgage loan rates, as I mentioned, around 7%. Total debt climbed, but mortgage originations are down 17%. So in my view, this is largely consumers dealing with inflation and relying on their credit cards to do so.
Dennis, there is a quick question.
Yeah, sure, Mark. Thank you.
Sure. This comes from Jeff. He said, are you familiar with Brent Johnson of Santiago Capital? Has a very interesting and accurate dollar milkshake theory. Would he be someone you might be interested in interviewing on the radio show?
Well, Jeff, I appreciate you bringing that up. I am not familiar with Mr. Johnson. If you have some information that you could forward to me, I would very much appreciate it. I am always looking for good guests, so I appreciate that input. And if you have some information on an article he's written or some contact info, I'd very much appreciate it. Mark, does that take care of Jeff's question?
That takes care of the question, and no more at the moment. So continue on.
And if there are some questions, go ahead and put those in the question box on the right-hand side of the screen. Housing, as we have been talking about, is declining. As you'll recall here on the Headline Roundup webinar in January, I suggested that I thought the top was in on the stock market. That certainly seemed to be the case. I also indicated that I would expect that home prices would start to follow stock prices lower. And while that has not been the case, it's not been totally obvious that that's the case, the evidence continues to mount that home prices are now going to be declining. We've seen an 8.4% drop, according to Wolf Richter, here in 4 months. Active listings are up. Price cuts are increasing as well. Richter, I think, makes a pretty interesting observation when it comes to the housing market. He says sellers are struggling with denial. Sellers are thinking their houses are worth more than they're worth just because we have been in a bubble. And bubbles have behavior that you can describe as a speculative mania or a collective madness, and prices rise to the point that it seems normal. And then as they reverse, it takes a while for reality to set in. And I believe we're in that transition period now. Price right, a home will sell, according to Richter, but right is where the buyers are, and they're a lot lower. So buyers now are getting a little bit fussier and a little bit more selective. Sales of all types of previously owned homes, houses, condos, and co-ops, fell by 5.9% in October from September. Let's just call that a 6% decline in 1 month. That's the 9th month in a row that sales decline. So you have to go all the way back to the beginning of the year before you see an increase in the sales of homes from one month to the next. So all year, home sales have been declining. Year over year, sales fell by 28%. Compared to the recent free money peak in October of 2020, sales were down 34%. 34% and 28% are the decline numbers. And if you look at year over year declines, not just month to month declines, year over year declines, we've got 15 consecutive months in a row that sales have declined, and then 9 months in a row that sales have declined when you look at from one month to the next. So this is now on a downward trajectory. The chart really sums it up well, and this is again from Wolf Richter. If you take a look at the number of sales that took place in millions of homes, you see that they peaked back in 2005, 2006, going from a little over 7 million down to about half that by the time the financial crisis set in. We got almost back to the 7 million number in October of 2020. However, now we're back to under 4.5 million. So prices are starting to decline. I believe that prices will continue to decline. Sales of single family houses fell 6.4% in October from September, and by 28% year over year. Condos and co-ops fell 2% in October from September. Condo and co-op sales were down 30% year over year. Investors are also slowing their activity. If you're an investor or a second home buyer, you're not nearly as excited about jumping into this market. Investors and second home buyers bought 16% of the homes in October, down from the 17 to 22% range in the spring and winter. The plunge in sales, Richter writes, is a sign that potential sellers and buyers are in a standoff. Many potential sellers refuse to accept reality and lower their prices to where sellers are. I think that he means buyers there. Instead, they're thinking, and this too shall pass. They're hoping or praying for a Fed pivot. They're thinking interest rates are going to decline and they're going to get their price. I think those days are behind us. Homes that are priced right, and Richter defines that as meaning priced down to where the buyers are selling. But a lot of sellers don't like to go there, and you see that in the active listings as well. Active listings are up because many sellers are refusing to cut their price to sell their home. You take a look at price reductions on a chart, you see that a downtrend that's really existed from 2018 through the beginning of 2022 has reversed. For example, the number of price reductions was down to about 50,000 or so recently. Now it's back up to about 327,000 homes on which prices were reduced. If you were to draw a trend line on that chart starting in 2018, you see that the number of price reductions on homes declined significantly from 2018 through the end of 2021, and now we've got almost a parabolic increase in price reductions. So homes are not selling unless prices are being cut and reduced. If you take a look at the number of active listings as compared and take price reductions as a percentage of active listings, you see we're pushing now almost 50% of active listings have had price reductions. And finally, as we enter the
Dennis,
retail
can I interrupt
season,
real quick?
you may.
So question regarding real estate before we go into the last topic. This comes from William. Do you draw same conclusions for selling homes to selling vacant investment property?
Somewhat, yes. I would say that if the vacant property is farmland, farmland tends to track the price of agricultural commodities. So farmland can be a bit of an aberration. But other than that, yes, I would say that they're going to be related. And I think what we're seeing in commercial real estate is declining even more than the residential real estate that we're talking about here. So for the most part, yes, with farmland being the possible exception.
And related to the last topic, Michael asked, do you expect the stock market to correct or decline next year?
Well, I think when you look at stock valuations, which is really, where I like to look, if you take the Buffett indicator, which takes total market capitalization and divides by gross domestic product, if you take price to sales ratios, price to earnings ratios, stocks at this point are extremely overvalued, and we have not yet seen the impact that earnings declines will have on stock prices. I interviewed Gary Schilling a couple of weeks ago. We talked about that because the dollar, although it's weaker, absolutely, but the dollar has been stronger on a relative basis, stronger than the euro, stronger than the yen. A lot of U.S. companies that get and derive much of their profits from overseas sales are finding that the strong dollar is hurting them. So I think that you're going to see disappointing earnings, and I think you've got more downside in stocks moving ahead, both from just a valuation perspective relating to stock value versus the economy. And I think we haven't yet seen earnings adversely affect stocks. So yes, I'm expecting a bit more downside. If we see a lot more downside here in stocks, the question remains, will the Fed try to intervene? Will the Fed pivot? And do they have the capacity to inflate the bubble again? I don't know the answer to that question, but I have my doubts. So yes, I'm expecting certainly more downside here, particularly if the Fed maintains its current course of action.
And with respect, Dave asked the question, do you agree with Gary Schilling's portfolio positioning? Short stocks, short commodities, long dollar?
Well, Gary's long dollar because Gary is admittedly, I think he says, I don't know if he's ambivalent or agnostic. I forget what term he uses when it comes to precious metals. He doesn't buy metals. He's a hedge fund manager, so he's done very well shorting stocks this year. If you are a technical analyst and you can time your shorts, it's a dangerous strategy for many people, but I think there's money to be made. Trading options are going short moving ahead. Commodities, I think some of the basic materials, I agree with Gary on, and agricultural commodities. I don't necessarily agree with Gary. I think we're seeing futures prices on a lot of agricultural commodities now increasing. So that would be my difference there. And as far as the dollar is concerned, the dollar is going to be probably strong relative to the euro and the yen. But I believe that I would opt more for gold and silver versus dollars. So yeah, I agree that stocks will be down. I think a lot of commodities will be down, with the exception maybe of agricultural commodities. And the dollar, I believe, relative to the euro and the yen will be strong. But on an absolute basis, I would want to own some gold or silver instead of dollars. So that would be my position.
And that catches us up, so we can go on.
Mark, thanks for catching that. So last topic, Michael Snyder asked, will this be the last somewhat normal holiday season for U.S. retailers? He points out the obvious here. The holiday season is usually the most profitable time of the year for retailers, but it's becoming clear that spending will likely be down significantly in 2022. And he says there's a couple trends here that are really affecting retail. And he points out that the retail industry is critical to the health of the U.S. economy because the U.S. economy is more than 70% dependent on consumer spending. So he references a survey, and this survey revealed that more than a third of Americans say they're going to spend less on holiday shopping in 2022. Here's a bit from the survey. He said, as inflation forces consumers to spend more on gas and groceries, about 1 in 3 Americans plan to spend less on holiday shopping in 2022 than they did last year. Retailers have taken notice, hosting holiday sales earlier than normal and ratcheting up discounts to move merchandise. Stores want to draw attention to deals now before Americans decide to cut back further on non-essential spending, especially when 58% of the country already reports be feeling worried about finances. Couple this with the information that we discussed today, $351 billion more in debt in a quarter, almost 1.3 trillion more debt on the consumer level over the last year. Biden is saying to expect economic setbacks, and we're seeing real estate and stocks decline, which makes people feel poorer. So there's a perfect storm brewing in my view. Snyder said this is yet another sign that we're heading into a very serious economic slowdown, and it's extremely troubling news for major retailers. Target is publicly admitting that it's been forced to lower its expectations heading into the holiday season. Target's profit fell by around 50%, 50% in its fiscal third quarter as it cleared through unwanted inventory and sales slowed heading into the holidays. So Target came out and said, we're going to take a bit of a hit here in earnings. And I think you're going to see that across many sectors, not just retail. Snyder said if the retail industry was just facing a year or two, most retailers could survive that. But there's a couple long-term trends that are currently plaguing the industry that aren't going to go away in the foreseeable future. He talks about something that was really news to me, but I have verified it. He said, we're witnessing a tsunami of retail theft that just keeps getting worse year after year. If you can believe it, Target just admitted that theft from their stores will reduce their gross margin by more than $600 million for the full year. Target's taking more than $500 million hit from theft. The discount retailer told reporters on a call to discuss its third quarter earnings that inventory shrinkage or the disappearance of merchandise or theft has reduced its gross profit margin by $400 million so far in 2022 compared to 2021. At Target, year to date, incremental shortage has already reduced our gross margin by $400 million versus last year. That's according to Michael Fidelki, who is the chief financial officer at Target. We expect it'll reduce our gross margin by more than $600 million for the full year. Snyder notes this, we're not just talking about somebody stealing a few candy bars. $600 million is a lot of money. Target says these losses are largely attributable to organized retail crime. A Target spokesperson told Yahoo Finance via email after the call the shrinkage was mostly specifically attributed to this organized retail crime. Organized retail crime at this point has become a multi-billion-dollar industry in the United States. Highly sophisticated gangs of thieves are robbing our retailers blind all over the country, and things are particularly bad in states such as California, where penalties for shoplifting are extremely soft. This isn't just a problem at big box retailers either. The California Retailers Association has decried the rampant theft, which is hurting Golden State businesses, small and large. Theft has gotten so bad in some parts of San Francisco that it's beyond belief. San Francisco Times journalist Thomas Fuller told a grocery store clerk recently after moving to the city, I'm new to San Francisco. Is it optional to pay for things here? Sounds like a crazy thing to ask, but Fuller explains that he was genuinely forced to wonder what was going on after he witnessed people walk into Walgreens and Safeway, grab stuff, and walk out. Crime is not being prosecuted in many parts of California. I just read an article that someone who mowed down 25 police officers was released without bond, without bail. So this has gotten to the point of being ridiculous. Snyder points out that shoplifting is a crime against all of us because more of our favorite stores are being forced to shut down with each passing day, and prices, of course, have to be increased to compensate for that. Now, the other trend that Snyder points out is that the middle class is declining. Snyder points out that half of all workers in the United States made less than $3,133 a month last year. You cannot live a middle-class lifestyle on just $3,000 a month. More people are falling out of the middle class each month, according to Snyder. And one survey recently conducted found that almost 2/3 of Americans are now living paycheck to paycheck. According to a Lending Club survey, the number of Americans living paycheck to paycheck is reaching record levels. As of September, 63% of Americans were living paycheck to paycheck. That's just 1 percentage point below the record high of 64% last spring. A year ago, it was 57%. So inflation is taking its toll, and we are certainly seeing inflation now in many parts of the economy morph into deflation. So that's really, Mark, what I wanted to cover today. I think that puts me at just about a half hour, maybe a couple minutes over, but happy to answer any questions if anybody has them. And we will be back again live next week.
We do have a couple more questions.
Okay, terrific.
Jeff asks, Johnson speaks to the issue of dollar strength. The world reserve currency comes with some perks, and the Fed raising rates make the dollar relatively more attractive. When rates rise, the world comes here to invest, causing the dollar to rise even more, plus greater quantities of dollar-denominated debt, service, and commodities priced in dollars cause the dollar to rise too. This crushes economic strength in the rest of the world, who suffer from the double whammy of higher supply side inflation and then the hurt caused by dollar strength. He believes the dollar and gold will soon rise together before the system crashes, and we have to start over potentially with a good backed system. Guess that's just a comment.
Okay. No, nothing in there that I would really take issue with. I think, again, the dollar is much stronger relative to other currencies around the world. Ultimately, though, on an absolute basis, I believe we're going to see alternatives to the U.S. dollar develop, and we're starting to see that already, as we've talked about with the BRICS countries now developing and moving aggressively toward an alternate world reserve currency.
Okay. That is all we have for the moment. Great participation today. We got a good crowd for Thanksgiving week. A lot of good questions.
Yeah, terrific questions. Let me wish everyone a happy Thanksgiving. We're certainly thankful for our relationship with all of you and appreciate you guys, and we're very thankful for you getting the word out about what we do here. We are very appreciative and very thankful. So wishing you guys a very happy Thanksgiving with your families.
One quick last comment. Any comments on the crypto collapse from William?
Yeah, I talked about that on the radio show this week. I think that, I have said from day one that, I believe cryptocurrencies, to quote Voltaire, will ultimately return to their intrinsic value, which is zero. Now, as I've also said, that doesn't mean that Bitcoin couldn't go to 200,000 or a million, which it appears now that it will not, at least near term. I think a couple things are going to happen. I think that one, Mr. Fried, who was running that, came up about $8 billion short, and it appears that, or at least allegations anyway at this point, of large transfers of money, large transfers of customer funds that were unauthorized from FTX to the hedge fund that the same gentleman ran. So we're going to have to see how that all plays out. There's also a fair amount of politics involved in that, which I won't go into, but Mr. Fried was a big political donor as well. So we'll see how all that plays out and how all that enters into how all this is pursued. After FTX failed, I think that predictably you saw Janet Yellen. You saw many central bankers around the world and politicians around the world say that we need to regulate cryptocurrency. FedCoin is now taking a test run. Biden signed an executive order in March and wanted within 6 months to have a FedCoin test. That test is taking place. I believe that this is going to advance a central bank issued digital currency, which I am vehemently opposed to. I would encourage you to make your voices known to your legislators. We certainly don't want to have a central bank issued digital currency that would allow money to be frozen based upon social scores and some of the things that are being talked about. I certainly think it also creates a scenario whereby owning some physical metals, so you have some assets outside the banking system and outside the fiat currency system, will make a lot of sense. So, and I think now is a good time to buy metals. So those are just some brief comments, but I expect that this will advance the whole central bank issued digital currency, with politicians pointing to the fact that, you know, we can't trust the private sector to do it. We need to do it, which will, of course, likely end up being disastrous. So those are just a few comments. I do talk about it on the podcast this week. That will be posted tonight at the website or on the app. And I believe, Mark, correct me if I'm wrong, but that gets posted about 5 p.m. tonight.
That is correct.
All right. Again, happy Thanksgiving. We will be back live again in 1 week. Have a happy Thanksgiving.
Okay, we'll wrap it up there. Hey, thank you again, everyone, for participating today. Great questions. We'll be back again live next week, Monday, the 28th, to wrap up November. Have a great week. Have a great Thanksgiving and a Black Friday shopping season. So take care. Bye-bye.